Welcome to PwC IFRS Talks, your source of all things IFRS, technical accounting matters, business issues, current standard setting, and regulatory updates. I'm your host, Ruth Preedy. In today's episode, we're going to talk to a topic close to my heart, which is intangible assets, and I'm joined by one of our old favourites, Mary Dulson. Welcome back, Mary.
I think I'm going to take exception to the old.
Old favourites, as in you've been in the studio lots.
Okay, fine, right. But I'm young.
Very young. We've started. Okay, I'm not agreeing with that one. We started on a bad note. Anyway, to accounting, which obviously is what our listeners are listening in for, we're going to talk about intangibles. So I suppose what we normally do is start off at the top, like what is an intangible asset?
Okay. An intangible asset is an identifiable, a non-monetary resource without physical substance. Okay, we're done? Can we stop now?
Yeah, your brain. I need that.
All right. Examples are always easier with intangibles. Yeah. So in a pharmaceutical company, the factory that you make the pills in is a physical asset, a tangible asset. The chemical formula, the patents, the protection, the permission to make the drugs, the inspection of the facility, all of those are the intangibles that actually contribute the real premium cash flows to the product. So factory is tangible, all of the other stuff intangible, right? The right to collect rubbish in Phnom Penh was one of my favorite queries of all time. Mm-hmm. That's an intangible asset. In fact, today we call it a service concession, but this is a really old query. And not the trucks that you use to actually drive around and collect the rubbish. Yeah. So the right to do it, which you would evidence via a legal agreement or something like that, that's the intangible. The truck's tangible. If you go to the movies, the film is, even though it's got physical form, although increasingly that's digital.
Not so much, yeah.
Used to be great big canisters and, rolls of reels of film. It's not the actual thing. That's not the physical thing. It's the intellectual property of the film. Intangible asset, the cinema you're sitting in, that's the tangible bit.
Yeah. Okay, so you can't touch it. Brand name is all, one of the things people
classic.
Talk about, isn't it? Okay, so I think we understand what an intangible asset is. In accounting world, the key thing is, like, where do people go wrong? And we've only got 20 minutes.
We only got 20 minutes. Oh. Okay, so we won't do the long list. We'll do the short list. I think the most common misconception is just because a company spends money and expects future benefits, it doesn't make it an asset. So advertising, for example, isn't an asset. As soon as an advertisement is created, right, and finished and ready to be shown, it's expensed, right? Because it's not the physical copy of the advertising, it's I've spent the resources and I'm going to show it maybe in the future. That's just a deferral of but I've spent money, it's gone. Yeah.
And actually the standard even pulls that one out as an example. It isn't an intangible asset.
And I think there's actually been a specific IFRIC on that one, right? Or
promotional goods. Promotional goods recently, yeah.
So advertising, catalogs, free goods. In fact, anything that you spend on a brand that you own is expensive. The most valuable brands in the world, Coca-Cola is the classic example. Apple, how cool is that? Ferrari. Right?
Yeah.
It's not about the physical thing. It's about the brand, right? Yeah. None of those brands are probably on the balance sheet.
Yeah.
Right? Every dime that gets spent on them is expensed.
Wow. Okay.
Mm-hmm. Yeah. But if I went and was able to buy Ferrari, right, as a brand name, and I just bought the brand, or if I was able to buy Coca-Cola and I just bought the brand name, I could put it on my balance sheet because I acquired it separately. Therefore, I think it's paragraph 25. Separately acquired intangible assets. Probability is factored into measurement. Someone else sold it to me. I can put it on the balance sheet.
Yeah, it's one of the things that I think people that don't, sit and read the IFRS book all day, like we do, struggle with, because if you pay money for an intangible, you get to book it. But if it's yours and you've made it up yourself, it's just hidden.
It's just sitting
anywhere.
There. Yeah. I mean, and it is an asset. That's the other way that people go wrong. Yeah. I just haven't given it accounting recognition. So it's my intangible asset. So Coca-Cola with the red, because there's a specific color. I've forgotten what it's called. There's a name for it.
What a name for the red?
There's a name for the red, right? That's on nobody's balance sheet. There you go.
And it's probably going slightly off the accounting topic a little bit. Do you think that those intangibles should be on the balance sheet? Let's say fair value.
Every quarter? Yeah. Revisit it every
People
quarter.
Would love it.
Full Employment Act for valuers.
Don't get me on the board.
I don't think investors would think that was useful information. They want to know partly because nobody ever realizes their brand, or it's seldom that you realize your brand. They want to know how much it costs a consumer products company or an electronics company or even to some degree a luxury brand like Chanel. They want to know how much it costs to prop up the brand, because if you don't spend on your brand, it starts to deteriorate, right? So they want to know how much that costs, because that's cash outflow, and that's really what investors are interested in. And the way that you can kind of really see that is that the first thing companies start putting in alternative performance measures when they do them is they take out amortization of intangibles and stuff like that. Because again, it's not about cash. I mean, it's about cash I spent in the past. So I wonder if that's, investors are a little bit simple-minded. But it really is what's the current cash flow to keep the business, because that's the cash flow you need to generate the revenue, right?
Yeah.
So that's really what investors are interested in. I don't think that's going to happen anytime soon, although it probably would allow you to achieve David Tweedy's dream, which is the book value of the company and the market value of the company would then be the same, right? Because the easiest way to get to what's the brand value of Apple would be market cap less net assets equals brand value.
Maybe a balancing figure somewhere.
Yeah, a balancing figure in the billions, right?
Okay, so sorry, went off slightly there. Just interested to see, if you thought anything of that topic. So back to the what people do wrong. So the first thing is they think they can capitalize stuff that aren't intangibles. Yep. What are any other things you see?
Unit of account. You know me, I can reduce.
That's always an issue.
I can reduce any technical question to scope, unit of account, or consolidation, right? Unit of account in intangibles is very problematic because intangibles, by their nature, you only pay for things that are special and unique.
Yeah.
So one pharma company buys another pharma company. They might acquire hundreds of different intangibles. Each of them is unique. You cannot do them as a portfolio. So say you bought another pharma company and they had 10 drugs in development.
Yeah.
And basically you sit there and stare at them and wait for them to finish, right? And then they generate cash flows and you start to amortize them. Or they go bad and you write them off.
Yeah.
So as a CFO of a pharma company of my acquaintance said once, he's like, why am I only accounting for bad news? And I said, well, the alternative is to fair value all of them. He's like, no, bad. He's like, I'll go on accounting for the bad news. He said, but the portfolio. And I said, are they the same? No, they're not. The thing that makes intangibles valuable is the fact that they are unique. Do you recognize Apple brand anytime you see it?
Yeah, exactly.
That's exactly what they want you to do.
Yeah.
It's unique. It doesn't look like anything else.
Yeah. Even my 4-year-old daughter spots the apple. There's an apple. It's an apple.
It's pervasive. Right? Yeah. So it's hard to do a kind of portfolio approach to intangible assets. And in business combinations, once we broke people of putting everything in goodwill, now you tend to see a lot of customer relationships.
Yeah, definitely.
Customer relationships are always amortizing. Right? As I heard Wayne Carnell say once, customers die.
You could not have an indefinite life in time.
So it's got a finite life. Right?
Although I did hear a talk the other day that said, we're going to live till 300, so maybe the lives might be going up.
I don't know. But the point about the even individual customers, someday you're no longer going to be a customer. Yeah. More importantly, companies don't live forever anymore, right? So there's been some very significant enforcement actions recently, one of them against a company that bought a specialty engineering company, so acquired it, and it had about 20 big clients. And they said, okay, we've been doing business with those people for a while, and what we do is really cool and special, so we're going to deem them to be a portfolio of customer relationships, and it's going to have an indefinite useful life. And their regulator took a very different view and said, first, they are unique, right? Because each customer had different attributes, and because it was such a specialized thing that they did, they weren't even delivering the same product to each of them, right? Yeah. So one of the things people don't realize about oilfield services is how much technology is moving it forward and how much people are starting to use, artificial intelligence and drones and really, really taking technology into the hostile environments that is oil and gas. So they were doing these doing this kind of stuff, and each of those installations was unique. And the regulator said, each of your customers is unique. And so therefore you're going to amortize each customer relationship over the term. And by the way, if you lose a customer, you have to write up that customer-related intangible.
I think it also drives things like useful lives. Those contracts won't all have exactly the same end date, so your amortization, is going to be different.
So you probably have 2 customer intangibles for each one. So you'd have the contract, right? Yeah. So kind of the premium cash flows in the contracts that you had at the date of the acquisition, as well as you'd have the customer relationship itself. Yeah. Right? And the customer relationship, I think you could probably do over the average customer relationship period. Maybe it's 5 years or 7 years or 10 years, but it's a number, right? Yeah. And it's a number less than 20, I would guess. The contract is obviously limited to the period of the contract. Yeah.
So unit of account is always an issue. I've seen that with intangibles as well from a disposal perspective.
Yes.
So if you buy, you acquired a piece of IP, and in pharmaceuticals you might say sell that off in the future, and if you sold off a piece of it like America or an indication, there's nothing really in the standard that tells us how do we deal with that unit of account issue.
Probably their error, if there was one, was at initial recognition, right? Because if you buy, say, a branded pharmaceutical product today that's still in patent is producing premium cash flows, right? Those premium cash flows, actually, you would know where the biggest chunks of those premium cash flows are. And North America, because the U.S. is probably the most lucrative market for patented drugs, North America, the U.S. and Canada would be a big single line in the valuation model almost. So you would know how much of that value of that intangible came from the North American piece.
Yeah, it's so identifiable.
You could probably go back. It's identifiable, and you could sell control of it to somebody, right? Yeah. So if the company said, I'm going to sell you the rights to manufacture and market this particular drug in North America, I think you must derecognize. I think you must derecognize something, right? Yeah. And then the standard doesn't tell you how to derecognize, but I would look at the building blocks that created the intangible in the first place and go back and look at which one I wanted to.
Like you said, they sort of cut off a slice of those premium cash flows, so you'd expect some sort of
If I can identify the slice, I think I have to derecognize some of the intangibles. Yeah. One of the other things that you see with intangibles is people will sell a piece of the cash flows, right? And that actually is a different
kettle of fish altogether.
Exactly. Because if I sell you the rights to manufacture and make that drug in North America, I've lost control of it, and I've given that control to you, and it's identifiable, and you can enforce those rights against other people. Yeah. Right? If I said to you, give me $1 billion, and I will give you 25% of the net cash flows of this product worldwide after manufacturing, marketing, and whatever, maybe even tax, right? Now, right? All you've done is loan me money. Yeah. Right? And essentially, that is a securitization of future cash flows. And it is no different than a securitization of receivables or, people do commodity-backed loans. Yeah. It's asset-backed finance.
Yeah, right? Easy, and an easy one to miss.
It is. Because it's, it's expressed differently and described differently. But, and the amount to be repaid is not known at that date. But nobody's going to give you $1 billion without an expectation that they're going to get their $1 billion back, plus the cost of finance, at least.
Plus some interest.
Yeah, exactly.
So we're already coming towards the end of our thing. So last topic, one thing that's been discussed lots over the years at the IFRIC is this variable consideration. It's PP&E and intangibles, but obviously we're on intangibles today. Yeah. Just, can you give us a little bit of what can you actually do, and is the board going to do anything with it?
I don't think the board's going to do anything with it because they are not good at grappling with the liability question. And fundamentally, this is a liability question. Yeah. Right? So what is variable consideration and how does it arise? You sell me something today, right? Yeah. And we can't agree on how much it's actually worth, right? Or maybe I don't have the cash to pay you what you think it's actually worth. So you say, okay, I'll give it to you for $100 million, right? And then if the following good thing happens, you pay me another $100 million. Right? Yeah. Or if this drug gets to commercialization, so I go through all the patent and I start to sell it to people, you give me $500 million, right? So, but if it's a verifiable outcome, right? So something happens that you can see and touch, then I'll give you some more money. Yeah. Right. Today, under the standards and given the agenda decisions and stuff we have, we would say at initial recognition, debit asset, credit cash. Yeah. Right. you could, if you wanted to, estimate the amount you're eventually going to pay, probability adjusted, blah, 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 debit asset, credit financial liability. Nobody does that. What companies do is they say, when it looks like they're going to have to pay, right? So the good thing happens, they're going to pay the $100 million, debit asset, credit liability, right? Or credit cash, off the money goes. And we would say that because it's a verifiable outcome, I haven't just outsourced my R&D to you, you're not providing me services, you're on the beach, then that's okay. Debit asset, credit cash. And if somebody does book a financial liability, what do you do with the changes in the financial liability? I think once you do financial liability, all changes are financing. But I do think there's an argument, a school of thought that says you could put those changes on the balance sheet.
And I think when it went to the IFRIC, they discussed both those, didn't they? Initial and subsequent. And subsequent, they actually sort of solved that bit first.
You're like,
said,
wrong.
Actually, subsequently, you maybe could capitalise some of those, as long as it's not just interest, capitalise that as part of the asset. So we do have all these policy choices in here, which is then,
but I think that frequently, credit cash. When it's essentially virtually
not booking the financial liability on day one. I think it is in deep down in the list of long-term research projects at the board, but let's see if that ever happens.
I think, a little bit on the conceptual question, I don't think that's an asset question at all. That's fundamentally a liability. It's a question about liabilities. And if you think about the things that the board doesn't seem to be able to solve, fundamentally it's a liability question, right? Equity, it's a liability question. Provisions. We can't all agree on what IAS 37 means, right? So I think that this
is why we work in assets. I've just realised we keep well away.
Great career choice. So I don't think that there's any prospect for them solving that anytime soon.
Okay, brilliant. So I think that's a really good summary of some of the issues you see, Mary, in practice with intangibles. And we both tend to work in pharma, so we see these lots. That's why it's dear to my heart. We've come to the end of our 20 minutes. I could keep talking to you. I'm sure we'll have you back. We could have a part 20 on intangibles, really, couldn't we? So if anyone wants more information on intangibles, there's plenty on our website. Please go to pwc.com/IFRS. I've been your host, Ruth Preedy. Happy accounting. The preceding programme was brought to you by PricewaterhouseCoopers LLP. This content is for general information purposes and is not a substitute for consultation with professional advisors.